Hello, everyone. Hope you're having a nice weekend. I want to give you a little history slash market psychology lesson. And I think if you're a trader or you want to be a good trader, it really kind of makes sense to study history because we see these same things repeat. It's just like the verse there from Ecclesiastes. There's really nothing new under the sun. Now, I mean, I guess from a technical point of view, there are, right? Different companies, different people. But what hasn't changed is human psychology. And when we look at a chart, we have to look at it through the prism of what does it tell us about psychology. Now, the Dow Jones just got up to like, I don't know, 35.5, started to sell off. Why is there resistance at 35.5? I mean, is it because of the debt ceiling debate? Is it because of taxes? Is it because of this, because of that? Whatever. You want to think about it through that prism, you're going to have a really hard time trying to figure this stuff out. And I've been doing this for a long time, 25 years. In the institutional trading world, we don't worry about silly things like Elliott Wave or Gann theory. We look at price levels. What's important price levels? What's the trends? What's the momentum? Now look at this. How is it possible that in July of 23, right, a month ago, we got to resistance at the exact same level that we did in March and April of 22, over a year ago? Well, it's because of this thing called market psychology. There are investors who bought back here who experience buyer's remorse when the market goes lower, and they tell themselves, damn, I made a mistake. I'm going to sell my shares if I can get out of break even. So here we are over a year later. If you have enough remorseful buyers placing sell orders at the level that was resistance, it can become resistance again. You have to look at charts through this prism of market psychology and supply and demand. If you don't, you're never going to get it. How is it possible here that a level that was support in February of 22 became resistance in June of 22? This is another form of buyer's remorse. Okay, we have people who bought here who regret doing so when the market goes lower, and they tell themselves, damn, if I can get out at break even, I'm going to. So when the price gets back up to the level that they bought at, if you have enough remorseful buyers placing sell orders at the level that was support can turn into resistance. So that's my dog Clifford. We just ordered Chinese food, so I assume it's here. He's a good guard dog. All right, I mean, look at this, right? We can go all back through history and we could see this whole concept of some price levels are more important than others. I mean, you can see this on pretty much any chart. Support here became resistance here. Now this is for a full month. We have buyer's remorse. People who bought, price goes lower, they're like, damn, I made a mistake. I'm going to sell to get out of break even if I can. And they do. Now let's go take a little stroll down history and memory lane here. I want to go back to the late 1800s and the early 1900s because this is as far back as this chart goes. Now, unfortunately, I wish we had charts that went back to the beginning of the stock exchange in the late 1700s, but I just don't think we do. All right, so here in 1897 in August, we got to resistance around 39 or 40 on the Dow Jones, which, by the way, is now at 35,000. But yet somehow in November of 1900 all right, let me say again. From May of 1900 through November of 1900, it became support. Well, people sold and they tell themselves when the price goes higher, damn, I made a mistake. I want to buy my shares back, but I'm only going to do so if I can get them at the same price I sold them at. So just like we have buyer's remorse affecting the market, we have seller's remorse affecting the market. People sold here, Dow Jones goes higher, and it's kind of interesting because back then we didn't have ETFs and we didn't even have any mutual funds. But yet somehow the mass psychology of the market comes together to form these really precise levels. Resistance becomes support, seller's remorse. Resistance becomes resistance again, buyer's remorse. Now look at this. Here we got another one. Resistance in February of 1906 and October of 1909 became support in January of 1918. Why is it that a level that was support, like here, the 55 level in August of 1910, becomes support all the way through December of 13. This is the opposite of why resistance remains resistance. This is seller's remorse. It's a different type of seller's remorse. Well, I don't know if it's a different type, but it's a different dynamic in the market. There are people who sold here and they're like, yeah, the market goes higher. I'm going to buy my shares back if I can at the same price I sold them at. So this same dynamic that we see playing out then could be plays out now because human psychology has not changed. There are different traders, there are different companies, there are different stocks, and there are different people. But even though there's different people, the human psychology stays the same. I would be willing to bet if we saw charts of like the Roman Empire and whatever goods they were trading back then, it would look very similar. If I didn't tell you that this was from 1897 through 1921, you wouldn't even know. I could be like, oh, this is a chart of a stock that's trading now. Remember, it's psychology. Now, why do we get to support and bounce? Well, there are investors who are watching the market come in and they're like, all right, I'm going to buy, but I'm going to wait. And then all of a sudden, they notice the price isn't going any lower. Now, prices go lower because there's not enough demand or buy orders to absorb all of the supply or sell orders. When the price stops going lower, some of these traders who want to buy start to think, damn, there must be new trader or new buyers coming into the market. All of a sudden, they could absorb all the supply. So I better raise the price I'm willing to pay because if not, the sellers might go to someone else. They're going to go to whoever is willing to pay the highest price. So the buyers start outbidding each other, and this causes a snowball effect. It's not because of the news or whatever they're saying on CNBC, although fortunately back then they didn't have CNBC. It was the good old days. Why would something sell off of resistance? It's the exact opposite. The market goes higher because there's not enough supply to fill all of the demand. And the buyers are forced to pay premiums, and this forces an uptrend. Now, investors who want to sell notice, oh, price isn't going any higher. That must mean there's new sellers coming into the market. I better reduce the price I'm willing to sell at because if not, the buyers are going to go to whoever is willing to sell at the lowest price. So it becomes a snowball effect. Now, here we are in 1956, 1957. Resistance becomes support right here, the very bottom here. Maybe it's hard to see, but it's like right there. I'm going to put this in here. How is it possible? May of 56, July of 57, resistance, support in 62. Well, if you understand market psychology, you can understand it. If you don't, and you're just thinking about price to earnings ratios and artificial intelligence and this, that, or the other thing, you're not going to be able to figure it out. How is it possible that the level in December of 61 that was resistance becomes support in October of 66? I've explained it, right? Some price levels are more important than others. And if you want to be a good trader, that's one of the first lessons you need to learn. How is it possible that resistance in 66 becomes resistance in 68, becomes resistance in 72, becomes resistance of 76? Market psychology, buyer's remorse. Okay. Now, if I tried to explain this to you, like just kind of blindly, like you would be like, dude, I don't know if I believe what you're saying. And you know what? I would kind of feel the same way because it seems kind of miraculous or amazing that this would happen. But if you look at the chart, it's like, what can I tell you? Charts don't lie. Politicians lie. Analysts lie. Charts don't lie. Look at that. The top in February and May of 2015 is right where the market found a bottom in March of 20. This is the COVID crash. So if you were watching the COVID market crash and you're thinking, where should I jump in and buy? Oh, let me look in the past. Oh, this level was an important resistance level. That means there's a good chance it's going to be support because people sold there, going to want to buy their shares back. Okay, everyone. Thank you so much. Make sure you check back, and I will see you soon.